As the saying goes, there are a million ways to make $1 million. Well, there are probably a million strategies and indicators with which you can approach the crypto market. But that overload of info and choice can be overwhelming, to say the least. That's why today we're discussing some key indicators and tools that help us cut through the noise and identify opportunities for profiting in crypto. My name is Guy, and if you want to sharpen your edge, then this is just the video you need. First up though, let me make one thing clear. I am not a financial advisor and nothing in this video should be considered financial advice. This is purely educational content meant to inform you about strategies and tools to improve your analysis of the crypto market. So if that sounds good, hit those like and subscribe buttons, smash that notification bell, and let's get into it. Now, crypto markets are known for big moves, and at the heart of those moves is one word: momentum. With that in mind, let's start with the least sexy but possibly the most effective indicator for identifying momentum: the 200-day moving average. Now, in simple terms, this is just the average price of a crypto over the last 200 days plotted as a line. Above it generally means bulls are in the driving seat. Below it means bears are in control. It's blunt, but that's the point. And some of you may be thinking, yes, Guy, everybody knows about the 200-day moving average. However, here is how you can use it without getting chopped to bits. First, keep a watch list of projects you actually like, preferably ones with teams shipping products and that have large communities and a strong narrative. When one of those coins has lived under the 200-day for weeks or months, such as ETH in this example, and then finally closes a full day back above it, that is a potential buying opportunity. If the next few daily candles show follow-through with price continuing to trend up, that is a strong indicator of bullish momentum. Conversely, if ETH were rejected by the 200-day on 2 or 3 consecutive daily closes, then that's a strong signal that the momentum just isn't there yet, and that's your signal to stay away. Now, for those who may think that this is elementary, the difference between a good 200-day buy signal and a bad one is context. The bullish price action approaching a reclaim above the 200-day should be accompanied by a real fundamental catalyst. This could be something like a new product launch, a tokenomics revamp, or a surge in user growth. Additionally, stablecoin supply growth is another simple but powerful indicator. More stablecoins often translates to more dry powder waiting to enter the market, which helps confirm whether the momentum you're seeing has further fuel. If stablecoin supply is expanding while your preferred token is getting a 200-day reclaim, you can be more confident the move has legs. If it's shrinking, you should be pickier. And this is where the hard part comes in, and that's when to ignore the 200-day. Essentially, it's when the fundamentals don't match up with the technicals. This could be something like a large multi-month supply unlock or prominent team members jumping ship and ditching the project. You also want to consider the backdrop from BTC and ETH. If flows are screaming the other way, like persistent ETF outflows or visible digital asset treasury stress, that's not an ideal setup for your altcoin of choice. So, with all that said, here's a way to put these indicators together. Remember, the key is to let momentum nominate the trade and let fundamentals validate it. The 200-day moving average gives you the nod that a downtrend might be over. The catalyst and flows tell you if it's worth stepping in. When they align, that's a green light for buying. And yes, this is deliberately simple, but simple doesn't mean easy. Patience is your edge here, and most market participants lack it. You don't need to predict the next meta and catch the absolute bottom here. That's not what it's about. It's simply about identifying good setups in which you can have conviction. Remember, this is about maximizing your chances of success in the market. Refining your strategy is the primary thing to focus on when looking to make the most of your returns. However, there are other things you can do to boost your bottom line, such as checking out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. So, All you need to do right now is hit the link in the description or scan this QR code. And once you get on the deals page, you'll see all of our offers across a range of exchange partners. Click one of the Sign Up Now buttons and that should take you right to the deal. Now, these deals won't be around forever, so take advantage of them while you can using that link down below or the QR code. Now, we've looked at identifying trends, but what about identifying the major tops and bottoms those trends set? Well, crypto natives have a long list of indicators to help identify macro tops and bottoms, and for today we'll look at two of the most powerful ones, the Pi Cycle Top and the MVRV score. Now, these are a bit like market thermometers, not strict buy or sell signals, so just keep that in mind. Starting with the Pi Cycle Top, it's just a combination of two moving averages on BTC, one short and one longer. When the fast line, that's the 111-day moving average, crosses above the slow line, the 350-day moving average, this tends to correspond to a top in BTC's price. Looking at the chart and its track record of identifying cycle tops, it might look like sorcery. But in reality, it's just a way of flagging when price has run far enough and fast enough to confirm that we have a truly frothy market. The model's been discussed for years and its track record is pretty impressive, but it's not perfect, although no indicator is. So, how do we actually use it then? Again, context is king here. Practically, the Pi Cycle Top is best viewed as an alarm. If Pi lights up into frothy funding, vertical candles and a news cycle that reads like a victory parade, that's a reliable indicator that you should be looking to sell. It can flash a bit early, but starting to sell when that alarm goes off is the sensible thing to do. In any case, it's one of our preferred indicators when it comes to identifying cycle tops. Now let's move on to the MVRV score. Intimidating name, but we'll break it down simply and we'll just refer to it as the Z-score going forward. This top and bottom indicator uses on-chain data to guide us. In the simplest terms, the Z-score shows us whether BTC is overpriced or underpriced compared to a proxy measure of what most holders paid for it. It looks at the gap between today's price and the realized value, or cost basis, and then adjusts that gap by how extreme it has been in the past. In even simpler terms, a high Z-score means lots of unrealized profit, usually lining up with frothy market conditions where tops are formed. On the flip side, a low Z-score means a significant number of holders are in the red, historically lining up with bear market bottoms. In our view, it's been one of the cleanest ways to answer the question of how stretched the market is on a high time frame, whether that's to the upside or the downside. Now, here is where things get interesting. Even as BTC's price has roared upwards and set fresh records this cycle, the Z-score hasn't screamed into the classic red extremes. It's been chopping around in the lower mid-range since the start of 2024. What does that mean? Well, it tells us coins are being absorbed and repriced steadily rather than whipped around by the usual retail melt-up we're used to seeing in previous cycles. As you might have guessed, big buyers like ETFs and digital asset treasuries, or DATs, such as Strategy, appear to have changed the rhythm. When flows like that are relentlessly buying dips, or simply buying as price goes up, a lot of supply gets re-anchored higher, and those once dramatic Z-score spikes look a lot more muted. That is a big reason why we don't expect the Z-score to behave exactly like it did at the 2017 or 2021 top. So, how do we read the Z-score in practice right now? Well, if the Z-score starts ripping higher quickly while ETFs and DATs are stalling or reversing, that smells like froth. That would mean the price is going up without the strong bid from big players that BTC has been enjoying this cycle. If the Z-score cools while holders' cost basis keeps climbing, that's usually healthy absorption. Coins are migrating to stronger hands and the market is digesting gains. Now, while the Z-score may exhibit some strange behavior around BTC's top this time around, it seems likely that it will still create a clear bottom as it has in the past. Historically, the best long-term risk-reward shows up when the Z-score is washed out because it means the market is underwater, weak hands are exhausted, and any marginal demand has a bigger price impact. So why do we expect a clear bottom signal from the Z-score? Well, because there's plenty of long liquidity set to be wiped out whenever crypto slips into a harsh bear market. And that build-up of long exposure is not isolated to leveraged retail either. A few months of a broader BTC downtrend and/or a tighter funding environment spells trouble for many of the smaller crypto treasury companies out there. That could force the liquidation of smaller crypto treasuries, then mid-size firms, and so on. And that could be a nasty downward spiral, the exact environment that pushes the Z-score into the bottom of its range. So that's something to keep in mind when using Z as an indicator going forward. It'll likely be more reliable as a clear bottom signal than a top signal. Now, with all that said, where can these tools potentially mislead us? Well, as mentioned earlier, Pi can fire early in distributed tops, and the same is true for the Z-score. And for the Z-score, well, there is a scenario where it could end up staying in the mid-range for a long time in a market with intense flows. It's worth noting that the Pi cycle top indicator could also fail to trigger for similar reasons, namely a gradual grind higher in price that causes the fast line to move up more gradually rather than spike as it did in the past. What we want to avoid here is treating either of these indicators as gospel. And once again, as you might have guessed, the key here is context. ETF and crypto treasury behavior, fresh unforeseen catalysts, macro shocks, interest rate cuts, stablecoin growth, all of these need to be considered when using technical indicators. Indicators and technical analysis are useful tools when used appropriately. And while some question their value, we simply say, if this stuff is good enough for Stanley Druckenmiller, it's good enough for us. Having said that, it is important to match your technical indicators with some fundamental analysis. Charts don't live in a vacuum. Signals either have fuel or they don't, and you need a framework to bring it all together. Your job is simple. Pair clean technicals with at least one live, verifiable tailwind, and be cautious when the backdrop argues with the chart. So first, let's have a run through a quick checklist of broader crypto market fundamentals. We've already mentioned ETF flows, and if we look at this summer, the signals weren't subtle. ETH funds pulled in nearly $4 billion. That's a very clear allocation preference from big buyers, and it changes how we judge a 200-day reclaim on anything tied to the ETH complex. Stablecoins are now the lifeblood of crypto, particularly in DEX trading. Rising supply means more sideline dollars ready to chase leaders. Total stablecoin market cap is now above $280 billion, and that's basically fresh kindling when price action turns supportive. If stablecoin supply trends up while your favorite token gets a daily close through resistance, a breakout carries more weight. However, supply cuts both ways, and token unlocks are what traders often forget. Even in a healthier month, billions in new float can hit, so always check the emission schedule of a token you're considering. September alone will see $4.5 billion unlocked across the altcoin spectrum. And while it's true that broader bullish momentum can overcome unlocks, you're likely better off focusing on tokens that don't have heavy unlock schedules in their immediate future. And now let's zoom in to something more altcoin specific. And here we need to acknowledge one big shift that could influence your trading decisions. Increasingly, crypto sectors are seeing runaway leaders, and they appear to be opting for sovereign apps. What do we mean by that? Well, instead of deploying on Ethereum or any of its layer 2s, leading apps are increasingly deciding to set up their own chains. This lets them control execution, fees, and user experience, and they siphon users and liquidity as a result. Hyperliquid is the clearest example of this, being by far the most popular perp DEX for trading futures on-chain, all confined to its own isolated ecosystem. So why does that matter in the context of our discussion today? Well, if your technical indicators are flashing bullish, the broader fundamental backdrop is bullish, and you're looking at a dominant leader that's eating up market share with catalysts coming in the near future, well, you have a very, very good bet. That doesn't mean you have a guaranteed winner. Nothing is guaranteed in markets. All this means is that the odds are in your favor, and doing your fundamental analysis to match with your other indicators pays dividends. Now, so far, we've covered indicators for trending markets and the fundamentals that bring it all together. But what about those periods of sideways action? Well, they require a different set of tools. And before we dive in here, it is important to note that you don't actually have to trade a sideways market at all, and many would argue that you shouldn't because there's a high chance you get chopped up. However, if you are looking to execute some smaller trades during the chop while sitting on your main portfolio, these tools, in context, will help you. First up, the Relative Strength Index, or RSI. Now this is a simple momentum gauge from 0 to 100. In sideways markets, it shines. On the daily time frame, when price is near support and RSI cools towards the lower band, around 30 to 40 or lower, we look for a bounce to get in. If price is near resistance with RSI hot, roughly 60 to 70 or more, we look to exit instead of chase. But again, the key is context. In this case, whether the market is trending or trading sideways. RSI isn't as useful during trends because it can stay overbought or oversold for ages and steamroll traders who misuse it. Treating it as a tool for ranging markets is best. At the same time, though, relying on it less when markets go from ranging sideways to trending is equally important. Next up, we have the Bollinger Bands. Now these are essentially like elastic guardrails around a simple moving average. They expand when volatility rises and tighten when the market falls asleep. What's cool is that touches of the outer band often revert towards the middle band. But when the bands squeeze, be wary. That is like a coil winding and a bigger move is likely brewing. Now, for trading a sideways market, combining RSI with Bollinger Bands can be particularly powerful. If we see RSI heating up over 70 into overbought territory while price tags the upper band, that's a good spot to sell. The same is true vice versa. The main thing here is not to, as they say, diddle in the middle. You want to focus on the outer bands. Now, while we did just run through indicators that help with shorter-term trades in a sideways market, we should stress again that this is far from mandatory for securing profits. Sitting in cash during chop is not cowardice, it's often the right thing to do. And what's more, keeping dry powder means when a real setup appears for those highly profitable trending longs, you can size with conviction instead of just nibbling. And let's be honest, crypto markets can be stressful, and limiting yourself to taking only the best setups can preserve your sanity and likely boost your gains. Your spending on fees shrinks, your stress drops, and our best investments stop competing with our worst impulses. You don't have to win every single day, and patience is perhaps the biggest market edge of all. Well, that's about it for today's video, but if you found it helpful, you can help us out by smashing that like button and hitting that subscribe button while you're at it. And if you want to learn more about how we're looking for a cycle top, then you can watch our video on just that right over here. As always, thank you for watching, and I'll see you next time. This is Guy, over and out.